Hello everyone, welcome to Highest Forest. As you already know, I am Highest Zida, and this is where we guide traders from foundations to freedom. If you are new to our channel and you find our content helpful, please don't forget to subscribe and turn off the notification. If you like our content, please like and comment. Without wasting much of our time, let's get to business. So guys, in this video we talk about price action patterns. First of all, we have to understand what price action patterns are. We have to know what it is. A lot of traders do trend lines, but they don't really understand what is behind, or the psychology behind what they are mapping out with the trend lines, right? So you can see clearly here it says, what are price action patterns? It said these are easily recognizable patterns in the market which can be used to predict future behavior. These patterns are formed in the market by the combinations of impulses and corrections. That's another thing, right? And it says, what are impulses and corrections? It said, an impulse is simply a strong move in the securities price. When I talk about securities, I mean anything having the candlestick chart. The synthetic, the indices, the index, the currency pairs, the gold, the metals, the CFD, anything having candlestick chart is what I embed into the word security. So it's a strong move in the securities price, coinciding with the main direction of the underlying trend. So when you say like if you have a market going up, you're in an uptrend, creating higher highs and higher lows, right? So when you have an impulse to the upside, which is in line with the trend you are looking at already, then that is an impulse. When you have a strong move to the upside, since you are in an uptrend already, when you have a strong move to the upside, is what is called an impulse. And then it says a correction. A correction is a weak move in a trend. A weaker move. When they say a strong move, it's just like it has consecutive candles in that same direction of the trend. But the correction is a weak move in a trend. A weaker move when you see the market not giving you strong candle bodies, giving you wicks and wicks. That is when that formation is called a correction. I said this move tend to create swing points, which aids a better understanding of price pattern and what exactly is preaching to happen next in the market. Yeah, like I said, it's in the definition we said easily recognizable patterns in the market that help predict the future behavior, right? So it is in the correction that you get to understand the future. The impulse is for you to combine it, so that you can get to understand what pattern it's really being called and then what next to happen. But the correction is where main predictions happen. It's where the main information lies, inside of the correction, inside of the pattern you draw, because your patterns are drawn on corrections. I'm sure you guys know that already. If you don't, you have to watch our videos, go to our channel, and you get to understand more. Then we have types of patterns. It said continuation patterns, and then we have reversal patterns. Just like the name implies, if you read, you're gonna understand. Continuation patterns are the ones that just pause the trend and they help it to continue in the same direction, right? It's just continuation. Then reversal, you know the word reversal. It changes, it reverses. If it was going upward, when this reversal pattern happens, it has to change to the downside, right? So let's define it. Said continuation patterns. These are price action patterns that only occur as an accumulation of momentum for price to continue in the same direction or trend as the initial impulse. It just happen for accumulation. Sometimes, like I said, the correction is where you get to predict more where the market is facing, right? The correction is also where traders who don't understand the fact or the term of liquidity are being liquidated. That is where money are being grabbed, because when you see the market trying to go up, trying to come down, trying to go up, a lot of impatient people get into buy, get into sell, and then their stop losses are being taken. So that kind of place, like I say here, is an accumulation. That is what the word accumulation is talking about. Those who are impatient and then placing trade in between these impulses and correction, not waiting for them to get the pattern is trying to form before getting into the market. They are going to be accumulated. Their stops are going to be accumulated for the market to get a momentum to continue in the initial impulse. That's the continuation pattern. The market has to continue after that correction. When it forms that correction, it has to continue in the initial impulse that brought it to that correction. We'll explain more when we look at the chart. All right, then you say there are different types of continuation patterns, but we have found that the flag is most effective. The flag patterns, because yeah, somehow most of all of other patterns look like the flag. Most of them look like the flag. It has an impulse and then it's having a correction. The correction is always sideways, even if it's steep, even if it's flat, even if it's tight or expanded. It's most of them are looking like the flag. So we are looking more to the flags. We're going to explain more of the flag patterns to you guys in this video. Then it says the reversal patterns. These are price patterns that signal a change of trend, just as the name implies. Reversal patterns occur to change the already existing trend to an opposite trend, to an opposing trend or an opposite trend. Then say from research and countless backtesting, we have found wedges and descending patterns to be most effective when it comes to patterns that aid in the reversal, that aids the market to reverse, that aids the market to change. It is either a wedge or a descending. Sorry, yeah, this is supposed to be a wedge, descending or ascending, because when I talk about descending, it's a change from a downtrend to an uptrend. So when I talk about ascending, it's supposed to be from the uptrend to a downtrend, right? And then the wedge, you know the types of them, the ascending wedge and the descending wedge. So can somehow, sometimes I like to call all of this. I like to call them the running channel, because I call them run channel because I will explain more when I get to chat. So let's make this correction, because I'll leave the link to this document for you guys in case you want to look at it furthermore. So we have found out that running channel are most effective when it comes to reversals. The running channels are most effective, right? So let's hop on the chart and get to understand more of what we have just read. So guys, this is pound dollar, the GBP USD. Let's look back to our document again. It says price patterns are recognizable patterns in the market that help to predict the future, and then a combination of impulses and corrections, right? So that's what I want to talk about here right now. Impulses and correction. And I define impulse to be a strong move, or yeah, a strong move in a particular trend. Now if you look clearly, let's look at this bit of price from that ends like this. If you look clearly at that, if you already understand how to identify trends in the market, you know we are in a downtrend, right? Because we keep creating this higher lows and lower highs, you understand, and lower lows. So we are clearly in a downtrend, right? Clearly it's the market is falling. Even if you don't know how to identify the trend, you see the market fell at where we point out to look, right? Then we said an impulse is a strong movement in that direction. So if I like to zoom in, if I zoom in clearly, you can see that this is an impulse in this direction, right? This is an impulse. This, you see the market came down aggressively. The market is, it dropped aggressively in that direction. You see, since we're in a downtrend, whatever happens to the downside is an impulse. You see, this was an impulse. This was a very strong impulse. You see, the market came down aggressively. Then we had a correction. Now, when it says correction, it says it's a weak move, right? It's a weak kind of move. You see, it's a weak, like the momentums are not strong. The candle momentums are not strong. You see a little candles, and then candles with a lot of wicks. It goes there, come back, goes there, come back. So this is what is called a correction. This is clearly a correction. So how come, like we said, the patterns are formed by the combination of these two? How come about the patterns? Is it the combination of these two? One, two. So clearly we see that this is a correction. If you don't know how to use the trend line, look in our channel. You get to understand more. I'm actually making this video for those of you in a Discord group who are finding it, a little bit hard to differentiate between an impulse and a correction. So this is a correction. You see, we are in a downtrend. So whatever happens to the opposing side, like the uptrend, the upside of the market, like since we're in a downtrend, we're supposed to be expecting a lot of high momentum bearish candles. But whatever happens to the opposing side or tend the market to be in a sideways, then it's clearly a correction. So this is another correction. This is another correction, right? This is another correction, because we had an impulse. This bearish, you see the bearish ran to the downside, then the market started to correct sideways instead of keep dropping. We have a lot of corrections before. We have a lot of corrections. Where are they? This is also a correction in its own way, but if you are in the community, you get to understand what we call impulsive correction. So there's an impulsive correction in this particular trend, which is this one. So like I said here, we said we have filtered a lot, and then we got to understand that the flag is the most effective, right? Now the flag which is most effective, you can see very well. Let me explain to you guys a little bit about flags. This, like we said, the impulse is what a strong movement in the direction. Let's take for example, we are in an uptrend, right? And then we have this bullish run to the upside. Take this to be your candles. We have that bullish run to the upside, right? Then when the market started correcting, we have some kind of, it dropped down, it went back up, it dropped again, went back up, it dropped again, then that's it, right? This is what we call a flag. When you see a correction that is looking like this, is what we call a flag. A correction looking like this is what clearly we call a flag. Even if you don't understand on the chart what a flag is, if you hear the name, you just have to compare it to the flags you see on your street, the flag you see in your schools, in your offices. This is how the flag is. It has a pole, then it has a flag, the main flag on it, right? So this is how it looks like. And then that is for a bullish flag. Then we always anticipate the move to continue, because we call it what, and the continuation pattern. Since it has an initial impulse from here facing up, after correcting, we anticipate it to keep facing to the upside again. That is why we said here that we said on the this place, like we said, these are price action patterns that only occur as a accumulation of momentum for the price to continue in the same direction or the trend it was initially, right? Now what we talk about accumulation there is when people see the market, you see there are people who still don't understand phases of the market. Like when we talk about the impulse phase and corrective phase, there are people who still don't understand liquidity. People are still there who are impatient and can't wait. So a lot of people like trading the double bottoms will also be here taking their buys. A lot of people trading the double tops will be there taking their sells. And then you can see very well that the market have been, messing around. When you come here, you take your sell. If you're not conservative enough to leave, you get back here to take your stop loss, and then all of that. So that is the process of accumulation. When people are buying and selling within these patterns, market stopping them out is what is called accumulation in the market. When people are being stopped out of their trades, it's accumulating money so that it can pay to those who are patient enough to wait. That is the whole thing about liquidity. If you don't understand liquidity, please look in the link in the description below and contact us to join our community, and then you get to understand more about liquidity, because that is basically what we have filtered that it is not really involved in the Falcon strategy. So let's talk about the bearish flag. It's just, the market is two faces, or it's two options in the market. Is that you buy or you sell. It's bullish or bearish. So that's selling or buying, right? So the bearish is just like an opposite. So when you have an impulse to the downside, this is like from the upside coming down. When the market is bearish, the market is selling. So it's an impulse to the downside. Then you have this correction, went back up, opposing the trend, came back, went back up again, came back. Then let's leave it there, right? Sorry, my stuff is looking like head and shoulder, but I don't want to call it that. I want to call it a flag. Pardon my drawing. This is just using the tools. So this is a bearish flag, right? And then since it's a continuation pattern, we have it to continue to downside, because we only had an accumulation here, or just a rest, just the market to have a little breathing space before continuing the trend. That is why we call it a continuation pattern, where it impulse from, after correcting, it goes in that same direction again. That is why we call it continuation patterns. So let's go to our chart. You can see clearly we have marked a lot of bearish flags here. You see that we have an impulse from the upside, corrected, and then we continue to the downside. We have an impulse from the upside, corrected, and then we have an impulse to the downside. The market, I want you guys to always have at the back of your mind that the market is never going to be perfect, right? Whatever kind of drawing you see on the books, the textbook explanation of the market is never going to be exactly like that. The market is always wanting to catch traders at the wrong side. So it can't be as perfect as it was drawn in the book. This is a bearish flag, kind of steep, but it is still a flag because it has a bearish pole and then a little correction, and then you see it still continues to the downside, right? So that is a bearish flag. Let's look for a bullish one. Let's look out for a bullish flag. Where can we find some? Alright, I think I have. Now this is a bullish flag. You see we are this ends. Let's look at this from here to there. You see we are clearly in the bullish market, right? Because the market is creating higher highs and then higher lows. You can see already, even if you don't know what is higher highs and higher lows, you definitely know the market is going up because you see it facing to the upside. So from there we can mark more impulses and more corrections and then try to understand that they are bullish flags, right? Now you see here we had an impulse from this end. See the bullish run to the upside, that is an impulse. Let me zoom in. You see the bullish run to the upside. You see all bullish candles, strong momentum candles. That is why we call it an impulse. It has no swing highs, it has no swing points. It's just candles, candles, candles. But this one is having swings. You see a swing low, a swing low, a swing high, a swing high. So together connecting this together, you can see clearly it is a bullish flag. You can see clearly it's a bullish flag. We have patterns here or reasons here in the lower time frame to get entries from, and then boom to the upside. So it was an impulse, correction, and impulse. So it is a continuation pattern, right? If you also look at this one is a little bit choppy and tight for a less experienced trader. That is also a bullish flag. If you scale down the time frame, you get to understand it's an impulse, correction here, and then an impulse to the upside. We have these. Look at the impulse from here. Impulse, we have this correction, and again another impulse to the upside. So that is a bullish flag. It's just opposite of the bearish one. And then the correction, we said they help us to what easily take trade. Let's go back to the reading and say swing points, which is, they said the correction is this way. I'm reading, right? The correction is a weak move in a trend. This move tends to create swing points which aid a better understanding of a pattern and where exactly it is preaching the market to go, or what exactly it is preaching to happen next in the market. So it is this swing points it has. Whenever a market leaves the trend line, it has to go to the other side. So when it's on the trend line, that is what it is in the correction that helps you to get a better understanding. The corrective phases. So the price patterns help us to take trade on the correction so that we can capitalize on the next impulsive legs. So we don't want to get in when the market is far gone. We don't want to get in at the wrong place. The patterns helps you to get the market where it's the way the impulses are starting. So this is a bullish flag. If we're looking more, we can get more of them, but I think it's clear and very easy for us to understand, right? So let's read to the bearish structures. It says reversal patterns. These are price patterns that signal a change of trend, just as the name implies, reversals, right? And I said, from research and countless backtesting, we have found running channels to be the most effective when it comes to patterns that aids to change trend. Running channels. Now, this is the reason why I call it running channel, why we call it running channels. They are called running channels because when you have a trend, because when you have an impulse to a particular direction, and then the market is kind of like going in that same direction but not really impulsive, just creating highs and lows and highs and lows in that same direction of the impulse, then we call it a running channel because it is still in that direction but it's no more impulsing, it's only running. There's a difference when they say something is impulsive, there's a lot of strength and momentum in it, right? But when you say it's running doesn't have a lot of strength in it. Now this is clearly a running channel. We have this impulse to the upside. You see this long momentum candles here. This is an impulse. Then the market is still going in the same direction of the impulse from there till this ends. The market is still going in the same direction of the price is still going in the same direction, but it is kind of back and forth. You see, just up and down, up and down, up and down. So that is what we call running channels. No, now we use this to understand where the market is about to make reversals, right? So if I was having this impulse and then I had this 1 2, this was a very good signal on GU 1 2 3. If I have this structure, then I know that the uptrend or the buyers are losing momentum. That is why its initial impulse is not as impulsive as it's supposed to be anymore. Instead, it is back and forth, back and forth. So this is a running channel. If you look very well, a lot of them, and then we know that when the market touches the trend line, it is very impactful, especially the third touch. You see, this was the one, this was two, this didn't touch, and then this is the third one. And then you see, after the third touch of the running channel, you see it impulsed downward like a lot of sellers. 1 2, this is clearly the third touch, and then from there, you see the market sold greatly. You see the market sold greatly to the downside. So this is a reversal pattern. They are all looking like this. Whenever this pattern happens, that is when I look at the market to reverse. And then you have to understand structure, so you know which one to look at mostly, because patterns occurs anywhere, anytime, because the market is never impulsing, it's always impulsing and correcting, impulsing and correcting. So you have to also understand structure to know which of them is relevant for you to look for yourselves or for your buys or for your signal. So having this as master structure, I know whenever the market leaves a trend line, you have to come to the other side, right? So if I had this structure and I have this channel within it, I know it's a good sell for me. Let's look more of the structures, more of the running channels. You see, so uh this is a bullish one which caused a bearish reversal. It's a bullish running channel which caused a bearish reversal signal, right? So we see more of it again. We see another one here. This is a running channel to the upside. We have this impulse to the upside. Then the whole of this is a running channel. You can see the market is still going up, it's still in the uptrend, but it is having lesser momentum. It is no more impulsing. Instead, it is correcting to the upside. This is no more impulsing, but it is running up. So we call it a running channel. And then a bullish running channel that calls a bearish signal. You see, I'm not teaching signals or entry or anything. I'm only teaching patterns, like the patterns that does the correct that does the continuation in the market, and those that do the reversals. You understand? So please try to practice this on your own too. You can see the difference between this and this is that this guy is having the impulse from the upside, right? And then this guy is having the impulse from the downside. So let's say in a nutshell that the reversal patterns have their impulses from no have their correction in the same uh, direction of the impulse. That's like basically for you to understand it. You see, we have this impulse here and then we have this correction. So this is a reversal pattern. There are a lot of things that are preached here that made this not to come here. But I'm not teaching signals, I'm not teaching top analysis, I'm only teaching you to spot out these patterns for yourself. So this is a reversal pattern right there. If we look into the chart deep and deep and deep, we have a lot of them, a lot of running channels, a lot running channels. Then that was bullish, right? This is a bearish running channel. You see this 1 2, you see that it has an impulse to the downside, and then it's still going down but in a corrective manner, so we call it running. Whenever I see that, I know the market is about to turn. Whenever I see this, I know the market is about to turn to the upside. So that is a bearish running channel, signaling a bullish reversal. We have a lot of them. This is GBP USD. We're going to look to this. We're going to look into synthetics index for those who trade synthetic. There's also another running channel right here. It's a reversal pattern. You see it running to the upside, and then you see, because the impulse is from there, and then it is running to the upside, creating higher highs and higher lows. So it's a reversal pattern. Those are the patterns we call reversal patterns in the market. So I think this is all. Let's look into the synthetic index and then get to understand more of this for those trading synthetics. This is Varsity 75 index, and then you can see clearly we had a running channel to the downside which caused a bullish signal, bullish reversal, and then we capitalized on this in the community. We have This, you see, the impulse was from the upside to the downside, which is the market is in the downtrend, right? Like an impulse to the downside, and then we have a correction to the same downside but in a corrective way. So that's what we call a running channel, and then it's a signal that the market is about to turn to the upside. You can see clearly the market respected that prediction. We have a lot of them. If you look into the charts, you're gonna get them. The market is very very sweet when you understand these charts. So this is another one. You see, this is a reversal to the upside. That's a running channel. That is running. You have to practice these things so that they can get used to you. This is an impulse, though it is a little impulse, but you see the correction to the same way and then reverse to the upside. I think when you understand why the market reverses and why it should continue, you should be good. Like you have a little edge, because when you understand why it turns, why it should continue in that direction, and why it should not, or why it should reverse, then you should, be more confident in your trades. When you are holding a trade, when it forms some kind of patterns, you should know if you are to leave or to stay. It also helps in trade management, right? It also helps in trade management. You can see a bigger one here. We had an impulse to the downside. There's an impulse to the downside. I was using that too for liquidity count. This is an impulse to the downside, and then we have a correction to the same downside but in a corrective way, and then we had the boom bullish reversal to the upside. You see, so that is a running channel. So the patterns I look at mostly is the flag. This is, you can see, this is a bearish flag here, which aids the continuation of the market trend, and then the running channels, which aids the reversals of the market. Please make sure you backtest this. Try to see them on your charts before implementing them to live trades. All right, once again, if you are new to our channel, don't forget to subscribe, like and comment. Thanks for watching.